Now, I've always wondered, people leverage banks. How about we actually leverage the stock market to actually buy us real estate? Could I theoretically, if I have money in the stock market, take enough money to actually invest into real estate while not actually touching the money I'm invested in to the stock market? Basically saying, I'm only going to invest my stock market profits and I'm actually going to keep my money in there and make it grow and grow and grow while I'm still investing into real estate. Is that actually possible? The answer is, it is. And by the end of this video, you'll know exactly how to do it and exactly what I mean if I confused you just a little bit. Now, as always, guys, like this video on top. Also, subscribe and hit the bell to get notified. Now, the first part we have to understand is basically the standard performance of the stock market and what I'm actually invested into. Now, my only investment right now in the stock market is into the S&P 500. The 500 largest companies in the US. I lose money if the entire US basically goes down as a whole. And if that happens, the entire world is probably gonna go down because our economies are so intertwined. So I don't need to be making a bunch of different investments. This way is cheaper, easier, and a lot more easier to manage, okay? So that's my only investment. Now overall, this has made over the past 72 years around 10.54%, but let's cut it down to around 8% on average. Let's say that if I have $1 million invested in the stock market, I'm going to make 8% on average. That's around $80,000 in profit. So the idea would be, although not everyone has that much money, including myself, by the way, but the idea would be, is there a way where if I have $1 million of my own money invested, I could actually take out the profit, leave enough in to continue to grow my money and still invest into real estate? The answer is yes. Now, let's go ahead and basically lower that number from $1 million, lower it down to just $100,000, which is a lot more doable and a lot shorter time by an average person, okay? That's actually a lot more doable. To have 100K in the stock market is a lot doable, okay? So how do you do this, okay, guys? Well, the answer is, if we use the 4% rule, basically saying we're gonna take 4% of our portfolio from the stock market every single year. If it grows by 8%, we're only taking half. So the other half is going to continue to work in the stock market for us. So what is 4% of $100,000? The answer is absolutely $4,000. Now, to buy $4,000, what can I actually buy with $4,000? The answer is a lot, believe it or not, okay? So in stocks, 4K gets me 4K worth of stocks, but in real estate, let's say I have a strategy. And my strategy is I'm gonna get FHA loans, okay? First time homeowner loans, okay? So I'm gonna put down 3.5% on a property. That's the idea, right? I'm gonna live in it for 1 year, and then I'm gonna go ahead and basically turn it into a rental property. That is not mortgage fraud. It's completely possible and legal. If I have $4,000 and I divide it by my down payment of 0.035%, how much property can I actually buy? Well, the answer is about $114,000 worth. Now, let's say you have closing costs and everything else. So let's just say, for example, you could technically buy somewhere like around like $100,000 to around $80,000 worth of real estate. Now, if you actually buy this property, pay the mortgage for like a year, and then you basically turn into a rental, that's a possibility. But if you buy, for example, a duplex, you live in one part, the other part you actually rent, that rental part can cover your mortgage. The answer is that's also doable. So the idea is you could take your 4% you take from the stock market. And by the way, Tommy, would you recommend I take more than 4%? The answer is it depends on you, man. I personally wouldn't do it because the idea is when you take 4%, the math shows that basically you only run out of money in like the worst markets possible. And even then, the money's probably gonna last you around 33 years. So it lasts you a very long time and you're able to withstand any real catastrophic problems in the stock market. That's the idea. But let's say, for example, I have $100,000 in my taxable stock portfolio. By the way, the reason this doesn't work with retirement accounts is basically because there's penalties involved, right? So if you take money out from your Roth IRA or your IRA or 401k, there might be penalties involved. So if there's a penalty of 10% and you'll be taxed at regular income, the answer is it's not going to be worth it. But whenever you take money out this way using the 4% rule and it's a taxable account, you'll pay taxes, but it'll be capital gains tax, and you can be taxed anywhere from 0% to 15% to 20%. And the big benefit of using stocks, which usually, they grow, they make you income, all this stuff, but it's usually better to leave that money in there, and you're not going to make like a crazy amount of money per se, like from dividends, right? So the idea is if I can take money from there, put it into real estate, I'm more diversified in a way, but I also get cash flow. So I get cash I can actually use while the property still appreciates in value over time, right? I want to have cash in my pocket to live off without actually eating into my stock market portfolio. That's the idea. So that's like one big benefit to actually do this. But overall, you really want to be diversified, but you don't want to use retirement accounts overall. Now, there is a question. And the question is, if you have, for example, a taxable account with 100K, would I recommend you actually grab that $100,000 to buy property? You could do that, by the way. It's possible. You could do that, and with the profits you actually make from the property, put that into your into your retirement account to actually grow over time, tax-free. That's an option. Or you could take the money as a whole and buy yourself a personal property. That's also an option. But all these things, right? There are cons. The con is you no longer have the money in the stock market, and it will no longer be producing for you that 8% anymore. But you could have it into rental property if you understand that better and have that produce you money. It's all how you want to do it. Now, me personally, how would I personally do it? The answer is I'm not going to use my stock market money to leverage with banks and actually borrow more money. The idea is basically take money out from my stock portfolio and use that money to help me buy a property in cash. Now, let's say I do have to borrow money from a bank. I'm buying $100,000 worth of property, right? And I only have, let's say, $50,000 in cash. And I want to take out money from the stock market, and that's like $10,000, let's say. So I put that 50K plus 10,000. Now I have 60K, right? That's my first year of actually doing it. And then I can use my savings to put money into it. And once I have that property paid off, then I can buy the next one. That's the idea. Now, by the way, a question just arose in my head, which is basically, tell me, how often can I take 4% from my portfolio? The answer is annually. So for me personally, I'm only going to be doing this like on January. Some folks do it on December because that's like the big sell-off for the tax write-offs or whatever. But you can do it whenever you actually want during the year. You can do January, February, December, whenever you actually want to do it. But you do it once a year, and that's the whole idea behind it. But I'm going to use it to basically complete my funds to buy real estate. But I'm not trying to, for example, I have $1 million in the stock market. I'm going to take 40K out using the 4% rule. With that 40K, I can buy basically a bunch of real estate, because in real estate, it's like that, right? So imagine you have $40,000, you're putting down 20%, you can buy literally like $200,000 worth of real estate. That's a lot of money, right? But now you have literally minus your $40,000 you actually had, right? You have 160K worth of debt. So that's also a big deal too, right? So leverage is a double-edged sword. You want to be very careful when utilizing it. But for me, I won't be doing it this way, but I will be leveraging my stocks to help me buy real estate, diversify, make some income every month. But it's not via getting into more debt. That's the idea. Now, am I worried that I'm going to be eating into my stock market profits? The answer is no, because I'm still going to be saving up a big portion of my money to actually do this whole idea, this whole plan. So the goal is, with my savings, with the stock market, with the other properties that actually I'm going to have to make me some money from it, I'm going to grab the cash flow from the properties, my savings, the stock market to actually help me buy property, do that over and over and over again. And even though, let's say you're taking a tank in the stock market per se, you're still growing over here, the money overall is still being invested. You're not using the money to do stupid things with it, okay? So that's different, because when you take money out from the stock market and you buy a car, well, you just turn $20,000 into $10,000 in 5 years. But when you take $20,000 to buy a piece of real estate, in 10 years or 15 years, that money basically doubles in a sense, right? So that's the idea. You grow your money via investments. We're actually investing. We're not actually deteriorating our investments by basically putting that money into liabilities. That's the idea. But guys, thanks for watching. That's one way to leverage your stocks to actually help you buy real estate. And as always, like, subscribe, hit the bell, get notified. Comment down below real, so I know you made it all the way to the end of the video. On top of that, up here is another video. Over here is my face. As always, Long Term Team officially.